Hello friends, hope all of you are doing well. So in continuation to our lecture series on costing useful for your NHPC Senior Accountant Exam 2025, let's discuss some further questions in today's video as well. So friends, the first question is, the escalation clause in a contract is included to protect the option A, contractee against a rise in the price of the final product. Option B, contractor against a significant rise in the cost of inputs. Option C, subcontractor from non-payment by the main contractor. Option D, contractee against poor quality of work. So friends, think over it and let me know the correct answer in the comment box. Friends, the correct answer is option B, contractor against a significant rise in the cost of inputs. So friends, this clause allows the contractor to claim an increase in the contract price if the cost of materials or labor price beyond a certain point.
Friends, before moving on to the next question, I would like to inform at Finance MCQ, we are offering NHPC Senior Accountant Exam course. The course covers the entire technical syllabus, that is 140 marks out of 200 marks. An entire course is having subject-wise, topic-wise MCQs, including past exams questions from other PSUs of similar nature. And this course also include NHPC previous year exam papers, which will be helpful for your exam preparation. So do avail this opportunity. Visit Finance MCQ website, take a demo of NHPC course and start your preparation. Further friend, you can use coupon code NHSA100 to get flat 100 rupees off on the course price. So now let's move to the next question.
Friends, next question. In a process where there is opening work in progress, which method of valuation of equivalent production assumes that the units from the opening work in progress are completed first? Option A, weighted average method. Option B, simple average method. Option C, first in first out method. Option D, last in first out method. So friends, here what should be the correct answer? It should be option C, FIFO method. So friends, FIFO specifically separates opening work in progress from units started and completed in the current period, assuming the former are finished first. Moving on. Friends, next question. The key factor or limiting factor is a option A, factor that determines the selling price of a product. Option B, factor that limits the activity level of an activity. Option C, fixed cost that cannot be avoided. And last option, variable cost per unit. So friends, pause the video, think for the correct answer. The correct answer is option B, factor that limits the activity level of an entity. Friends, key factor is a resource that is in short supply and restricts the company's ability to produce and sell, such as the labor hours or machine capacity. Moving on, friends, next question. Inter-process profit is charged when? Option A, goods are transferred from one process to another at market price. Option B, there is an abnormal gain in the process. Option C, finished goods are sold to external customers. Option D, goods are transferred from one process to another at a cost. So, what should be the correct answer here, friends? Well, it is option A, goods are transferred from one process to another at a market price. So friends, when transfers are made at a higher price than the cost, it creates a profit for the transferring process, which needs to be accounted. Moving on. Friends, next question. If the company has a profit volume ratio of 40% and fixed cost of 2 lakh, what is the break-even sales value? So friends, in the previous lecture, we have solved a question where we need to calculate the break-even sales in terms of units. What was the formula in that question? It was fixed cost divided by contribution per unit. So friends, here they have asked break-even sales value. So here the formula will be slightly different. It will be fixed cost divided by profit volume ratio. So that will be 2 lakh divided by 0.4. So what is the correct answer? It will be option B, rupees 5 lakh. Moving on. Friends, next question. If the following is an example of a batch level activity in ABC. Option A, assembling a single unit. Option B, designing a new product. Option C, machine setup for a production run. Option D, factory rent. So what should be the correct answer here, friends? It will be option C, machine setup for a production run. So friends, a machine setup is performed once for each batch regardless of the number of units in that batch. Moving on, friends, next question. In a hotel, the cost of housekeeping staff salaries would be considered as option A, fixed cost. Option B, variable cost. Option C, operating cost. Option D, capital cost. So friends, here obvious answer would be option C, operating cost. So friends, in the service industry like a hotel, cost incurred to provide the service such as staff salaries are classified as operating cost. Moving on. And next question. The need for a reconciliation statement between cost and financial accounts arises because option A, different accounting principles, for example, accrual versus cash, are used. Option B, cost accounting is mandatory while financial accounting is optional. Option C, certain items of income and expenditure are included in one set of accounts but not in the other. Option D, there are frequent arithmetical errors in the books. So, what should be the correct answer here? Well, it is option C. That says certain items of income and expenditure are included in one set of accounts but not in the other. So this is the primary reason. For example, purely financial items like interest on investments are in financial account but they will not be found in cost accounts. Moving on. Friends, next question. When deciding on the most profitable product mix with a key factor, products should be ranked based on their option A, selling price per unit, option B, contribution per unit, option C, contribution per unit of the key factor, option D, total expected sales volume. So friends, don't get confused between option B and option C. The correct answer is option C, that says contribution per unit of the key factor. So friends, this metric shows which product generates the most profit for each unit of the scarce resource used, thereby maximizing overall profitability. Question: scrap value realized from a normal loss in a process account is typically option A, credited to the profit and loss account, option B, credited to the process account to reduce the cost of the process, option C, ignored in the cost account, option D, treated as a part of abnormal gain. So, what should be the correct answer? Please pause the video and think over it. Correct answer is option B, credited to the process account to reduce the cost of the process. So friends, the realization from selling normal scrap reduces the overall cost of the process. It has to be absorbed by the good units. Moving on. Friends, next question from contract costing. So in a contract which is 95% complete, the amount of profit to be taken to the P&L account is usually calculated as option A, two-thirds into notional profit into cash received divided by work certified. Option B, notional profit into work certified divided by contract price. Option C, estimated total profit into cash received divided by contract price. And last option, the entire estimated total profit. So the correct answer, friends, here is option C, estimated total profit into cash received divided by contract. Friends, this is a prudent and commonly used method when the outcome of the contract can be reliably estimated as it is near completion. Moving on. And next question. Process costing is average based, making it less suitable for option A, controlling cost of a specific customer order, determining the cost of a homogeneous product. Option C, industries with continuous production. Option C, calculating the cost per unit when production is uniform. So friends, here they have asked least suitable for. So the correct answer should be option A, controlling cost of a specific customer order. In fact, for the other options, process costing is the most suitable one. So friends, here, since costs are averaged over all units, it is difficult to trace specific cost to a particular order. So which is the strength of job costing? Moving on. Then next question. A company produces 10,000 units. The variable cost per unit is rupees 5. Fixed overheads are rupees 20,000. If closing stock is 1,000 units, what is the value of closing stock under marginal costing? Option A 7,000, option B 5,000, option C 2,000, option D 25,000. So friends, pause the video and try to solve the question. One hint I can give you is that in marginal costing, only variable cost is charged to the production. So friend, as I said, the variable cost per unit is rupees 5, closing stock is 1,000 units. The correct answer will be option B 5,000 rupees. So friends, marginal costing values stock only at its variable production cost. So 1,000 units into rupees 5 per unit will be rupees 5,000. So option B was the correct answer. Moving on. Continuing from the previous question, what would be the value of 1,000 units of the closing stock under absorption costing? So friends, absorption costing, both fixed and variable overheads are charged to the production. So friends, here first we'll have to calculate total cost per unit. So friends, if you go to the previous question, we have already given variable cost per unit, that is rupees 5. So we'll have to calculate fixed overheads per unit. So 20,000 divided by 10,000, that will be 2. So friends, we have variable cost per unit at rupees 5, fixed cost per unit at rupees 2. So the total cost will be 7 per unit. So obviously the value of closing stock will be 1,000 into 7, that is option C, 7,000 rupees. So the correct answer is option C. Moving on. Friends, next question. So the following would be considered a cost object in costing. Option A, machine hour. Option B, a specific product line. Option C, the salary of the product manager. Option D, the direct material cost. So friends, here the correct answer is option B, the specific product line. Cost object is anything for which a separate measurement of cost is desired. This can be a product, a service, a customer, or a project. Moving on, friends, next question. An abnormal loss is valued at the same cost per unit as option A, opening work in progress, option B, the units transferred to the next process, option C, the scrap value of normal loss, and last option, the closing work in progress. So friends, a question from process costing. The correct answer is option B, which says the units transferred to the next process. So friends, abnormal loss units are assumed to have incurred the same cost as the good units that were fully processed during the period. Next question. Friends, a company is considering accepting a special order for which it has spare capacity. Order will not affect its regular sales. In deciding the minimum price for the order, the company should consider option A, the full cost of production plus a normal profit margin. Option B, only the variable cost associated with the order. Option C, the total fixed cost of the factory. Option C, the price charged to its regular customers. So friends, a tricky one. Pause the video, think over it. The correct answer should be option B, only the variable cost associated with the order. So friends, the minimum price must cover all incremental or relevant costs which are basically variable costs. So this will ensure a positive contribution. Moving on, friends, next question. Byproduct costs are often dealt with by option A, allocating a share of the joint cost based on their weight. Option B, ignoring their value completely. Option C, deducting the net realizable value of the byproduct from the cost of the main product. Option D, charging their value to the profit loss account as other income. So, what should be the correct answer? Well, the correct answer is option C, which says deducting the net realizable value of the byproduct from the cost of the main product. And this is a common and practical method. The income from the byproduct is treated as a reduction in the cost of the main production process. Moving on, friends, next question. The cost volume profit analysis is based on several assumptions. Which of the following is not a primary assumption of CVP analysis? Option A, cost can be accurately segregated into fixed and variable components. Option B, the sales mix remains constant. Option C, inventory levels will change significantly during the period. Option D, selling price per unit and variable cost per unit are constant. So, what should be the correct answer here, friends? So, friends, here the correct answer is option C. So, we'll not assume that the inventory levels will change significantly during the period. So, CP analysis generally assume that the number of units produced is equal to the number of units sold, meaning there is no change in inventory. Next question. If profit as per cost account is 50,000, the factory overheads were over absorbed in cost account by rupees 5,000. So, what would be the profit as per financial accounts? Assuming this is the only difference. Option A 55,000, option B rupees 45,000, option C profit would be same in both profit as per financial accounts and profit as per cost accounts. Last option rupees 5,000. So friends, think for the correct answer here. Correct answer is option A 55,000. So friends, over absorption means the cost charged in cost accounts was rupees 5,000 higher than the actual expenses recorded in the financial accounts. So friends, this has made the cost profit lower. To find the financial profit, we must add back the over-absorbed amount, that is 50,000 plus 5,000. Correct answer is option A, 55,000 rupees. So that's all for today, friends. If you have any further comments or queries, as I said, please mention in the comment box below. So we'll meet in the next lecture. Till then, thank you very much for watching. Take care and goodbye.